forgive me, because I know you've been sitting here for quite some time, and William stole my line. He told you that he was sick, but as you can hear, I'm really sick. So I think he had man flu. I have woman flu, and you'll bear with me on that one. I was very impressed with the information that I heard this morning. I think the lineup and the structuring of the information to you frames the discussion today very well. You heard from the consumer protection perspective at a European level, and then you hear the proliferation, if I can phrase it as such, of legislation that's coming to improve the lives of consumers, regulators, and participants in the financial services industry. But I think one thing we can agree on is the degree of change, the pace of change, and the complexity that we all face in our various roles in the infrastructure, all of which align at the end of the day to produce outcomes for consumers, because it is only in the provision of sustainable products with repeat business from consumers that have confidence in the regulatory infrastructure, in the stability of the system that they operate in, and in the integrity and ethical dimensions of the firms that provide them with the services, that will make this a long-term repeat business, which I imagine is what all of us would strive for. I think, to give a little bit of context to you, to make it more interesting in terms of the domestic challenges that I face, because some of what I will say to you today, of course, will resonate in a national level only, but I'm quite sure that you can draw parallels in your own jurisdictions about the different experiences that you have faced in the past decade in terms of the aftermath of the crisis, the reaction to legislation, stability issues, etc. So if I can tell you that 10 years ago, this week, in the aftermath of the collapse of Bear Stearns, there was 3.5 billion euros were wiped off the share prices of Irish stocks, which was, for a small country, a seismic event. That, of course, was followed by Lehman Brothers' failure and the dislocation of international financial markets. We know that not just in my jurisdiction, but in very many European jurisdictions, this was followed by untenable suffering for consumers. We had austerity measures at a national level. We had unemployment, unsustainable debt for consumers, unsustainable debt for business. We had nationalisation of banks, and we had, in certain jurisdictions, taxpayers picking up the tab. And that informs where we are today, 10 years on. Excessive risk-taking sat underneath all of the causes for this, and governance failures. They were the central causes of the financial crisis, and they had a very significant impact on a small, open economy such as Ireland. Well, I'm glad to say that Ireland, again, because it is a small, open economy, is recovering well, and unemployment will go below 5% this year, which is a good marker of where we have come from. But we had to learn significant lessons from the crisis, and the institutional framework of the central bank had to be amended and strengthened. So, to put this into context, I think we're one of the very few in the world that is in fact a central bank, a prudential regulator, and a conduct regulator, all under the one house. And there is some great advantage in that, actually, in data and information sharing. And we live in a complex, interlinked world where these mandates cannot be looked at in isolation. But our key focus is on our mandates of financial stability, prudential regulation, and consumer protection. This integrated structure recognises that consumers are best protected when you look at a financial system that is in fact stable, that system is populated by firms who are well capitalised and financially sound, and of course where they have consumers' interests core to the centre of the thinking. So we have In our mandate, we are a systemic regulator. We safeguard stability and protect consumers. And the debate today has ranged across other component parts of a domestic and international financial services structure. But in our jurisdiction, the mandate for consumer education rests with another agency. So too does complaints in terms of ombudsman. Education and competition matters rest elsewhere. But we have a vision that is backed up, as it must be, by a comprehensive and enforceable body of legislation. That must be complemented by rigorous supervision. And of course, the third component part of any effective regulatory system is enforcement. That does include powers of redress where consumers have suffered detriment. To give you some insight into the scale of the financial services industry, we regulate approximately 10,000 financial service providers who provide services both domestically in Ireland and internationally. In our role of authorisation, we operate a strong gatekeeper role by requiring firms who establish in our jurisdiction to comply with their legal and regulatory obligations and to act in the best interests of customers. We assess fitness and probity of individual directors and senior managers. We assess the adequacy of the firm's capital, internal controls, risk management systems, and the level of resources, and notably the expertise of their staff in provision of those services. We operate an assertive, risk-based approach to supervision, so the higher the risk, the higher the intensity and intrusiveness of supervision, and the more attention we pay those firms in our work. In our work, we seek to incorporate best practice. We recognise that consumers are operating in an international, connected world, and so we see our participation within the supervisory authorities at European level as critical to success and alignment. We participate actively with the EBA, ESMA, and I'm a board member, and EIOPA. And we also recognise that collaboration beyond Europe is very important. And we were founding members of an international organisation of supervisory authorities with responsibility for consumer protection, FinConet, which is currently being led by Canada. We chaired the EBA Standing Committee on Consumer Protection on Financial Innovation for the past 2 years, and we recognise the critical importance of financial innovation in the forthcoming period. We also recognise the OECD's role and take part in their Consumer Protection Task Force. We subscribe to the 10 high-level principles of consumer protection endorsed by the G20 finance ministers and central bank governors. Those non-binding principles include that financial consumer protection should be an integral part of a legal, regulatory and supervisory framework. That's only common sense. It's the fundamental starting point. That consumers should be treated equitably, honestly and fairly at all stages of their relationship with financial service providers, and that consumers should be given key information about the fundamental benefits, risks and terms of the products they buy. And we heard quite a bit of discussion about whether that's in fact the balance is effective this morning, and I'm quite certain that debate will continue. In our approach to consumer regulation, we put in place in 2006 a single consumer protection code. It was quite pioneering at the time because it was directional in the approach it set down for firms prescribing how products should be sold, the information to be provided to consumers, and how complaints should be dealt with. It also incorporated other overarching principles of fair dealings, integrity, and a mix of rules with a set of high-level principles was viewed as a good combined level playing field. The actual objective that we sought to achieve was that similar levels of consumer protection would be afforded all consumers of financial services appropriate to the area and product that they were buying, but a level playing field across the financial services industry. We complemented that already with a minimum competency code for the individuals who are working in financial services, with particular focus on the competency levels that must be attained for people with consumer-facing roles. This is important because it's actually the quality of the experience with the consumer that matters. But as we heard, things more and more are moving into digitization. The approach that we then implement in terms of our approach to regulation, we restructured our approach to financial regulation last year, and we split financial regulation into two pillars. One, in focusing on prudential regulation of the firms and the people that we regulate, and the other with respect to conduct, and that's the area of regulation that I head up. In the conduct pillar, we are responsible for consumer and investor protection and efficiency and orderliness of the markets. And in tandem with that, we sought to strengthen our commitment to conduct and consumer protection. A key part of that is that we enhanced our consumer protection risk assessment model by establishing a new and far more intrusive approach to supervisory assessments of regulated firms, particularly with respect to how they identify and manage conduct and consumer protection risk, an area that we really hadn't been significantly active in prior to that. This new model for us will be a key enabler in assessing how firms assess consumer protection risk, how their risk management frameworks are designed and governed, and importantly then we move on to test, are they actually delivering the outcomes in practice that we are led to believe that they will. We introduced this model in pilot testing, and what we saw was no evidence to link staff performance management incentives with consumer protection values stated by the firm. Product oversight and governance is an integral part of this model, and it means that in addition to assessing consumer protection risks, governance, controls and culture in regulated firms are also considered in this. The model assesses consumer protection risks in the product life cycle then, from product development right through to sales. We also recognise that we need to look at behavioural economics. Wall Street Journal reported earlier this year that Wells Fargo, you'll all be familiar, I presume, with this story, the US bank at the centre of a scandal involving opening unauthorised accounts, offered to reimburse more than 100,000 customers who were improperly charged monthly fees. Good, I hear you say. However, in implementing this right outcome for consumers, they went on to take an approach where the letters sent to the consumers used an opt-in strategy where people had to write back to claim the money. They were well aware that less than half of the people who were owed money would in fact bother to write back. They relied upon an inertia strategy well known in behavioural economics. Nobel Prize-winning behavioural economist Richard Thaler described the offer as slimy, as it was effectively nudging customers into the wrong choice by relying on their likely inertia. So we must be live to the practical implications of behaviour and those patterns. And we're conscious of the asymmetry between customers and financial service providers, and how we need to increasingly use behavioural economic insights to inform our expectations and rules and requirements in regulatory frameworks, because I have no doubt that firms are doing likewise. We need both regulators and firms to assist consumers to make better choices with the insights from behavioural economics and resist the use of so-called evil nudges to send customers in the wrong direction. That doesn't work for the long-term interests of any reputable industry. Now, we recognise the importance of behavioural economics in our work, and preventing firms taking unfair advantage of consumers is critical to your credibility in an industry. A core part of our work then is to undertake research on our own account, but because we recognise, I'm sure like you do too, that we live in a global and interconnected world, we also review the work of others so that we can learn from their insights. The aim is to prevent those negative practices to be used against consumers in the design or the selling of products. Now, we have found significant problems relating to teaser rates and hidden fees on credit cards, where companies take advantage of some consumers who are not fully informed. We've also seen where 3 pieces of information takes a consumer beyond the point that they can actually process that information and make an informed decision. We have found extrapolation bias when it comes to the purchase of mutual funds, where past performance is used overtly as an indicator of future performance. And we will publish this research later. Now, I've taken you through some of the theory behind what informs our work, and I'll talk to you a little bit about our practical approach. The central bank uses thematic inspections as its primary tool to assess sectoral conduct risks. These inspections focus on specific activity, product, or delivery channels across a number of firms, and this allows us to determine a benchmark or a standard on a product or in a sectoral area. And then we can assess whether further action is needed. The supervisory and inspection approach is predicated on sectoral assessments and supported by reactive work where problems or issues are detected. But the framework for consumer protection needs to continually evolve in order to deliver maximum effectiveness for consumers. And in that regard, we're considering supplementing the supervisory approach with firm-level engagement for high-impact firms or high-impact products in order to better protect consumers. And we think that in tandem with the new, more intrusive risk assessment, embedding the product governance and oversight approach, will get a more structured approach to supervision. Many of you here today work in the insurance sector, and you provide very important services to consumers and businesses, motor, life, health, and you help them with the costs when events arise. We believe that effective regulation and supervision of insurance companies is key, so that policyholders clearly understand the products that they buy, and they can have confidence that the insurer will have this financial strength to pay out on valid claims in the future. Now, we conduct regular themed inspections in the insurance sector, including the broker sector, and much of this we support in an evidence-based way with research. Now, last year, we actually did a piece of work around the consumer experience of purchasing Gadget insurance. First blush may not seem important, but when you think about the world of digitization, that's your smartphone, your tablets, they're very, very common and expensive items. And what we found is that the majority of customers did not understand the cover that they had. They thought it covered more than it did, and in fact, very many of them were paying for cover that they did not need. That is the kind of work that regulators can do to help understand on an evidence basis the issues that we face. We also routinely publish consultation papers which in advance set out our thinking on key topics, and some of this was referred to earlier. We recently published a paper on inducements in the intermediary sector, and we propose, in fact, to enhance the protections for consumers when those consumers are seeking advice or services from financial intermediaries. And what we propose to do is to include stricter rules on how financial intermediaries are paid commission or any other kind of inducement by the firms whose products they sell. We propose that they avoid entirely conflicts of interest created by poor design with inducement arrangements to give greater transparency for consumers on how the intermediary, whose advice they are relying on, is going to be paid, and indeed how much they may be paid. For example, we have proposed that it is entirely unacceptable for inducements to be linked to targets that do not link to the consumer's best interests, such as targets to hit a particular volume of a particular product, to hit profit levels of particular products, or business retention targets. They don't correlate with consumer best outcomes, and that's the matter under discussion. I want to move on and talk a bit about something that is really a very topical matter in regulation, and that is culture. They often say culture eats strategy for breakfast. And in the years since the financial crisis, significant misconduct scandals have occurred all over the world. Global banking and misconduct costs have now reached, it's estimated, over 320 billion, capital that could otherwise have supported up to 5 trillion of lending to households and businesses. Misconduct is bad business for financial services and for regulation. There are now real concerns that misconduct can undermine the safety of financial institutions, the trust and confidence that consumers have in the financial services industry, and as a result, there is an emerging trend towards intensive regulatory focus on governance, conduct, and culture issues. Mark Carney, the Governor of the Bank of England, pointed out last year that in fact it's so significant, the social licence of finance is in question, and he does recommend greater focus on improving the culture at financial services firms. Well, in Ireland too, we haven't escaped these scandals, and I took up my role on the 1st of September, and I have been very significantly occupied with a very serious mis-selling scandal in the banking sector with respect to tracker mortgages. And banks have been required to pay more than 319 million in compensation and redress to customers. And in fact, they have set aside in total provisioning more than 1 billion, or circa 1 billion, with respect to this scandal. And bearing in mind, I outlined that we are a small country, this is a huge scandal. And that led us to put in a collective redress scheme. It was referenced earlier, not existing at a European level. But unlike Wells Fargo, we ensured that payments are made up front, that you can keep what you have. You get your money with some payment for advice. You can appeal that and know that you will never get less than the initial offer. And you can still go to the Ombudsman and take an individual complaint if you wish to do so. And of course, the avenues in court are available too. But because we had to react to a widespread and systemic mis-selling scandal, it was seen as efficient and effective to design a consumer redress model to deal with these matters efficiently, effectively, as an extra option. But that has brought the reputation and the integrity of the banking system and their conduct towards their customers into sharp focus. And it is no use describing best interests of customers or fair outcomes of customers when persistently in every jurisdiction, I'm quite sure you all have a story of widespread mis-selling scandals, and they seem to be repeated time and time again. So this raises questions about principles, about rules, or is it really about culture and behaviour that informs those? But quite often I have noticed in my more recent engagements with senior people leading these institutions, everything is discussed or can be at risk of being discussed as a matter of process and procedure without an ethical dimension informing you with respect to, is it simply the right thing to do? So with that in mind, you've got to look at the culture in the lending institutions and the boards and senior management of those institutions. Are they living up to the promises of putting their customers at the core of their business? And linked to my description of the improvement that we see in our more focused and targeted consumer protection risk assessment, we see product governance and oversight, scrutiny of governance, and life cycle of products as a complementary intrusion with respect to the demand for cultures in financial services that deliver better customer outcomes. We're undertaking behaviour and culture assessments now with respect to the main lenders, and we're supported in this work by the Dutch Central Bank, who are recognised global leaders in cultural assessments. The assessment will identify not the decisions, really, but the behaviours that inform the decisions and the structural patterns that affect the way that consumer needs are considered in the decision-making process. The assessment will analyse the leadership behaviours of the management board and the potential risks related to the behaviour and culture of those boards that might impact on the stability of the bank or particularly detriment to consumers. The output of this will happen in June of this year, and we will publish an aggregate report on culture with specific recommendations on actions to be taken in the regulatory framework or if we need additional legislation. Some of the mitigations that we may consider is, I've already referenced, perhaps the need to have more intrusive on-site firm-specific engagement with regard to important products or important firms, and these also could include requiring lenders to conduct an annual audit of culture, requiring the boards of the lenders to set up ethics subcommittees, and I think importantly, linking incentivisation to appropriate behaviours that you say, in fact, will deliver the consumer outcomes. That's a structured, clear, measurable approach. We'd have done this earlier if this was easy, but this may be a valuable way for industry and regulation to put the consumer in an effective position where they are at the centre of the decision making. We're also considering the merits of the senior managers regime in the UK, which requires senior managers to submit a statement of specific responsibilities that clearly states the matter for which they are both responsible and accountable. This will assist in assigning responsibility to individuals in a regulatory context and decrease the ability of individuals to claim that it was not me, not anybody, I don't know who, but whoever it wasn't at this committee. It will minimise the ability for significant decisions and a focus on consumers to fall through the cracks. It has often been my observation in recent years that all senior board members would know capital ratios, liquidity requirements, but I do sometimes wonder if they know anything or enough about their consumer conduct, risk assessment and thinking in their firms. So, getting the culture right is important not just for consumers, but also for the shareholders of these institutions who are faced with substantial costs of paying for the misconduct of the institutions in which they invest. In short, we will expect the leaders of these institutions, senior managers and boards, to lead in the rebuilding of trust with their customers, the shareholders and the wider public by ensuring they focus on creating a culture which puts the long-term interests of the business and its customers first, and shareholders are aligned with that thinking. I just want to end in terms of enforcement, because it is a key core part of effective regulation. Since the crisis in Ireland, we've taken a concerted effort to be clear and robust in our enforcement obligations, and we take a serious approach to fitness and probity requirements of the leaders of these institutions. And as a practical experience, what we have found is that where we do bring forward a robust challenge, we find that people withdraw rather than face a dispute or a case in that. And we've had more than 45 withdrawals in that regard. And in that time, we have published every single enforcement case outcome. That's more than 117. And in a small country, that's a respectable record. Of course, there's always more work to do. We have prohibited individuals as well as brought forward cases with firms. But a very important part of the enforcement outcomes, we've imposed more than 60 million euros in fines, with multiples of that in compensation or redress going back to customers. All of these outcomes are public, and I know that there's often a very tense debate about that, but actually the sky didn't fall down, and we find that it is only through transparent publication of the cases with as much detail as possible that other firms in the area can learn the lesson of the misconduct. There's a deterrent effect on the firm that partook in the misconduct, and it rebuilds trust and confidence in the financial services system, which from time to time, I think we can agree, has been tested. Thank you for listening to me.